You know, when you first look at the world of finance, it almost feels like they use a language that's designed to be confusing, right? It's just full of jargon and concepts that can make your head spin. Well, today, we're going to cut right through all of that noise. We're not here to just learn a few definitions. We are going to build a solid, unshakable foundation for your financial future. We're going to focus on the single most important distinction anyone new to the markets has to make, the huge difference between investing and speculating. And trust me, getting this isn't just a good idea. It is the first and most important step you can take toward real, long-term financial success. Okay, let's just jump right into this. Think about that for a second. Reckless investors. Doesn't that sound completely nuts? It's a total contradiction. Kind of like a spendthrift miser. I mean, how can you be reckless and a true investor at the same time? It doesn't make any sense. And yet we hear phrases like that all the time in the financial news. This just shows how twisted the language of finance has become. And this confusion isn't just some harmless mistake with words. It's incredibly dangerous. It has led so many good, well-meaning people straight down a path to financial ruin because they were gambling without even knowing it, all while they thought they were investing. To guide us through these investment basics, we'll be drawing on the principles and deep research of Mr. Majid Butt. Now, his background is pretty unique. He's an accountant, a software programmer, and a dedicated investment researcher. This mix gives him a really powerful perspective. He brings together financial rigor, the clear logic of a programmer, and a deep analytical mindset, which is going to be a huge help as we break down these foundational ideas. So, here's the roadmap for our journey today. First up, we're going to tackle that big question. Are you an investor or a gambler? Then, we'll lock in a crucial definition that's going to act like our compass. After that, we'll dive into the very real dangers of speculation. Then, we'll explore the two main paths you can take as a real investor, the defensive path and the enterprising path. And finally, we'll pull it all together to help you start building your own investment philosophy. All right, let's start with what is easily the most important question you can ever ask yourself before you put even 1 penny into the market. It's not, hey, what hot stocks should I buy? The real question is, what game am I actually playing here? Figuring out if you're acting like an investor or a gambler is the absolute bedrock of your entire financial life. Everything else, your strategies, your returns, your peace of mind, it all gets built on top of this one answer. The way people talk on Wall Street these days is just so misleading. It seems like anyone who clicks a buy button is automatically called an investor. But it wasn't always like this. You know, after the great market crash, most people thought common stocks were just a wild gamble. And ironically, that's when they were dirt cheap. Then, fast forward to a huge bull market, and those same stocks, now at super high prices, were suddenly being called safe investments, and everyone buying them was an investor. See how backward that is? The point is, we have to stop using this lazy language and draw a very clear line in the sand for ourselves. So, we've identified the problem. Now we need the solution. And to navigate the market safely, you need a compass. You need one simple, powerful rule that always points you to true north, to sound investing. The definition we're about to look at is that compass. You could argue it's the single most important tool you'll ever have as you start out. Let's read this, and I mean really read it, because every single word matters. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. This isn't just a friendly suggestion. It's a strict 3-part rule. If what you're doing doesn't check all 3 of these boxes, it is, by definition, not an investment. It is speculation. Full stop. There's no gray area here. So this definition is built on 3 solid pillars. First, thorough analysis. This just means you do your homework. You study the actual facts about the business behind the stock. You look at its finances, its management, its real value. It's the complete opposite of just looking at a price chart and hoping it goes up. Second, safety of principal. Now, this doesn't mean you can never lose money. It means you're protecting yourself from a permanent loss under any normal, likely scenario. You're building in a margin of safety, not just betting on some long shot. And third, adequate return. This isn't about getting rich overnight. It's about getting a satisfying, reasonable return for the risk you are intelligently taking. So if an activity doesn't pass our strict 3-part test, we have to call it what it is: speculation. Now, it's important to get this straight. Speculation isn't illegal. It's not immoral. In fact, a bit of intelligent speculation is necessary for the market. It's how new companies get funded. But we have to be crystal clear in our own heads that it is a totally different game. It's a game based on chance and what the crowd is thinking, not on the actual value of a business. This slide just lays out the difference in thinking so perfectly. An investor starts by asking, what is this business really worth? And then they compare that number to the market price. A speculator does the opposite. They see a price going up and just assume the business must be worth more. The investor calculates value. The speculator is basically betting on the greater fool theory, hoping that some other person will come along and pay even more for it. Here's a great little mental test. A real investor would be fine owning a stock even if the market shut down for a year, because they own a piece of a business. For a speculator, that daily price quote is like oxygen. They can't live without it. Now, while intelligent speculation might be a thing, it's a very, very tough game. What's way more common is unintelligent speculation, and people usually fall into three big traps. The first, and by far the most dangerous, is speculating when you've tricked yourself into thinking you're investing. This is where that fuzzy language we talked about can really hurt you. Second is taking it way too seriously when you just don't have the deep knowledge or skills. And third, and this is a cardinal sin, is risking more money than you can actually afford to lose. So what's the solution if you've got that little itch to gamble? Well, be honest about it. This quote gives us the perfect strategy. Put it in a box. If you want to speculate, treat it exactly like you're going to a casino. Take a small, strictly limited amount of money, an amount you are 100% okay with losing, and put it in a totally separate account. Call it your fun money or mad money account. But never, ever, ever mix this money with your serious long-term investment money. And, this is key, never add more to it just because you got lucky a few times. Okay, so now that we've built this big, strong wall between investing and speculating, we can finally explore the two main paths for a true investor. Let's start with the one that's right for the vast majority of people, the path of the defensive investor. This approach is all about safety, simplicity, and, maybe most importantly, peace of mind. This definition is just beautifully simple. I mean, take a second and really ask yourself, does this sound like me? You want your money to grow safely, but you have zero desire to make finance your full-time hobby. Your main goal is to just avoid making big, stupid mistakes. You want freedom. Freedom from constant worry, freedom from a ton of effort, and freedom from having to make stressful decisions all the time. If that's hitting home for you, then you're probably a defensive investor. So what does this defensive strategy actually look like? Well, it can be as simple and effective as this. A portfolio split right down the middle, 50-50, between high-quality bonds and a diverse mix of big leading stocks, maybe through a simple index fund. This balance gives you stability from the bonds and long-term growth from the stocks. And while you can tweak this mix a bit, say between 25 and 75% for either side, that simple 50-50 split is the most straightforward, no-fuss way to get started. All right, now let's check out the second path, which is a whole lot more demanding. This is the path of the enterprising, or active investor. And before we even start, let me be perfectly clear. This path is not for everyone. In fact, it's not for most people. It takes a level of effort, expertise, emotional control, and time that is way beyond what the average person can or should give to their finances. So the enterprising investor's whole goal is to get better than average results, to beat the market. But here's the huge catch. Your number one job, first and foremost, is to make damn sure you don't do worse than the defensive investor. It's shockingly easy to put in a ton of work and end up with lower returns, or even lose money. Why? Well, you're up against two massive hurdles. First, your own human nature, your emotions, your biases. And second, you are competing against an army of the smartest, best-equipped full-time professionals in the entire world. Beating them is possible, but it is an incredibly difficult art to master. So with all those challenges, how in the world can an enterprising investor even hope to succeed? This quote right here, this is the secret. You absolutely cannot get special results by doing what everyone else is doing. It's impossible. To have a real shot at beating the average, you have to follow strategies that are, 1, based on solid logic and facts, and 2, and this is the big one, they can't be popular. If an idea is popular on Wall Street, you can bet that any extra profit has already been competed away. The real opportunity is in finding sound ideas that the rest of the crowd is ignoring or just doesn't understand yet. So we've now laid out the entire map. We've defined investing, we've built a solid wall to keep speculation out, and we've detailed the two valid paths that a real investor can take. With this knowledge, you are now totally equipped to make a smart, conscious choice about what kind of participant you're going to be in the market. And this is the fundamental question that you have to answer for yourself. There is no right or wrong answer here. There's only an honest answer that fits your life and your personality. Do you really have the time, the temperament, the skill, and the genuine passion to go down the demanding path of the enterprising investor? Or does the simple, safe, and frankly highly effective path of the defensive investor just make more sense for you and your goals? Let's just summarize this choice one last time, really focusing on the mindset. The defensive investor's main goal is to avoid big, costly mistakes. They want a life free from financial stress and constant decision-making, and they're perfectly happy with a safe, adequate return that lets them sleep well at night. The enterprising investor, on the other hand, is willing to pour significant time and brain power into the hunt. They have the special skills needed for the job, and they're aiming for those superior returns by going against the crowd. Just be honest with yourself about which one of these columns sounds more like you. And so we end right back where we started. After everything we've talked about today, I want to leave you with this one last critical question to think about. Look, the market is always going to have its ups and downs. That's just what it does. But maybe, just maybe, the biggest, most devastating financial risk you can ever take is the one you don't even know you're taking, by gambling away your hard-earned money under the dangerous illusion that you are carefully investing it. I really hope this foundational video has given you the clarity and the confidence you need to take that next step. Truly understanding this difference between investing and speculating is the cornerstone of everything else. If you're ready to keep going and dive deeper into how to analyze securities and build a portfolio, you can subscribe to my membership to access exclusive videos on investment analysis that aren't available to anyone else. Thanks so much for watching.